We haven't got a price target yet from you for year-end next year. I know you're going to be putting that out in the next couple of weeks. One thing you are looking for, though, is this rally to continue. And, John, what I think is interesting about your call is this is not a rate cut call from you and the team. You're not looking for rate cuts until the back end, potentially, of next year. What is this call, John, this bullish, constructive view based on?
Well, it's based on a lot of things, Jonathan. Thanks for having me on the show. Always great to be on surveillance on Bloomberg. The big story here really is it's technology is really changing the way we live. We all know that, but we get kind of jaded about it. But the whole concept of the investment that's going into AI, the efficiencies that already AI as it exists create for profitability for companies, even in tough times, and the changes it can make for both that are positive for both the consumer and business, as well as the questions, as to what's negative about it, all overall says stock prices to move higher as technology feeds all 11 sectors or all the other 10 sectors or all the other 9, because 2 are predominantly tech, communication services, and infotech.
John, you absolutely nailed the year-end bull market rally. I can remember back in the summer, you were a pinata, why hasn't the market moved, and boom, here we are with a Stoltzfus bull market. Is it a bull market, and will all that cash, in your study of history, will a part of all that cash buildup we have, will that move into stocks?
I believe it will, Tom, and there are several things that are involved. You've got the baby boomer generation has already begun to retire for quite a while, but there's still a lot coming. And the problem for boomers is they may live longer than they ever would have expected when they first opened up their IRA or their Keogh plan, what have you. And so in retirement, people are going to need to own equities. Interest rates, well, we've got yields that are much more attractive than they were before. Net after taxes don't look all that good based on where inflation is today. And even if it goes to 2%, a 5% yield doesn't turn into all that much attraction. And owning good businesses is historically, past performance, no guarantee of future results, but owning good businesses that are well managed tends to be a good way to invest for the intermediate to long term. So we think that's good for equities. This looks like the best opportunity here, not at this moment necessarily, but generally speaking, at this period in time on the timeline, this looks like a great time for investors in equities, and a good time when all of a sudden bond issuers have to pay for the privilege of borrowing money so you can diversify.